We continue our deep analysis on HDFC Bank, one of the India's most tracked financial giant and one of the most debated wealth creation stock in market. But before that, make sure you subscribe the channel and like the video. Don't forget to subscribe. Thank you. In part 1, we have exposed the biggest misconception in investing. A great company and great investment are not always same thing. We analyze how merger effect, slower loan growth, deposit composition and margin pressure can make a stronger business look slower in short term. If you have not watched part 1, watch that first because today we go one level deeper. Today's question is bigger, sharper, and more important for your money. Does HDFC Bank need 15 to 20% growth to make shareholders wealthy, or can lower growth still create serious return? That is very important. This matters because many investors chase only one thing: fast growth. 20% growth, explosive charts, quick money, but markets are more intelligent than that. Stock do not reward growth alone. They reward growth relative to the price you pay today. That single sentence can transform your investing life. Imagine stock A grows profit at 20%. Sounds incredible, but it already trades at an expensive valuation. Expectations are extreme. Any slowdown can punish the stock badly. Now imagine stock B grows at 12%, trades reasonably, improves profitability, and gets re-rated by the market. Which one wins? Sometimes stock B wins easily. That is why valuation matters as much as growth. For HDFC, the real debate is not whether it is a bad bank. It is not. The real debate is whether current slower growth is temporary or whether the long-term growth profile has structurally reduced. That difference changes fair value dramatically. Now think like a banking analyst. For a mature bank, the key valuation drivers are earnings, CAGR, returns on asset, return on equity, net interest margin, credit cost, and price to book multiple, not just headline revenue, because a bank with moderate growth and strong ROE can still create substantial wealth. Now, an uncomfortable truth: a mega bank cannot always grow like a small lender. The base is very, very huge. When your loan book is massive, sustaining 20% annual growth becomes mathematically very difficult. That is not weakness, that is scale. So, when size increases, returns driver shift. Market then focuses more on margin recovery, better capital efficiency, stable assets quality, and re-rating potential. Now let us combine macro and micro. If liquidity improves, deposit pressure can ease. If rates stabilize, funding cost can normalize. If credit demand rises, lenders benefit. That is macro opportunity. But can management grow quality loans? Can it improve margins? Can it allocate capital efficiently? Can it defend asset quality? That is micro execution. Macro creates the wind, micro decides who sells fastest. Now, what would be bullish for HDFC Bank? Loan growth moves from single digit to mid tens. Deposit growth stays healthy. Net interest margin improves by even 20 to 30 basis point. ROE trends upwards. Valuation remains sensible. That combination can create strong returns even without 20% revenue growth. Now, what would be bearish? Loan growth remains muted. Deposit cost stayed high. Margin remain compressed. ROE stays average. Valuation remains rich without earning. That can create years of underperformance. So here is the real investor framework. Before investing, ask what growth is realistic. What valuation am I paying for the growth? What must improve for upside? What can go wrong? Is there a better use of capital elsewhere? That is buy side thinking. My direct view is very simple. HDFC Bank does not necessarily need 20% growth to create wealth, but it does not need enough growth, enough profitability, and sensible valuation. Without that trio, returns can lag. With that trio, patience can be rewarded. And remember this line carefully: having no position is also a position. You do not need to own every famous company. You need to own attractive risk reward. So the real question is not, is HDFC Bank good? The real question is HDFC Bank attractive today versus every other options for your capital? That is where real wealth creation starts. In part 3, we answer the final and most dangerous question: is HDFC Bank undervalued today, or it is simply cheaper for reason? Thank you very much. See you in the next video. Make sure you subscribe the channel. Thank you very much.